What is portfolio rebalancing and why it is important in investing? That's a topic for discussion today in the Market Secrets Investment Series. Before we head into this episode, I have one notification for you. In addition to this investment series, we have multiple learning series that are running in our website on price action trading, algo trading, trading strategies. Also, we have multiple data feeds being provided in our website. So if you are an active trader, you might find these data feeds very useful. So if you are interested in any of it, please check out our website, which is www.marketsecrets.in. With that note, let's jump into today's session on portfolio rebalancing. As an investor, everyone should have an asset allocation. We have discussed about this in detail at the start of the investment series. In short, considering we are investing for a long-term goal, which is at least 10 years away, if you are a safe investor, you should have a reasonable exposure towards equity, say 50 to 60 percentage. If you are a risky investor, you should have higher exposure towards equity, say 75 to 80 percentage. That's some basic raw asset allocation, and you should structure your investments in such a way that it is as per the planned asset allocation. But if market crashes or rallies, your asset allocation will go for a toss. This is where rebalancing will come into picture. So, why is rebalancing important for every investor? The objective of portfolio rebalancing is to ensure that your portfolio isn't singularly dependent on the success or failure of a particular investment, a particular asset class, or a particular fund type. So, let's take an example. Let's assume you have invested 40,000 rupees per month in equity mutual funds and 10,000 rupees in EPF or PPF every month. It is being done by keeping in mind 80-20 asset allocation. That is, your asset allocation is composed of 80% equity and 20% debt component. So, yearly you are investing 4.8 lakh rupees in mutual funds and 1.2 lakh rupees in PVFs. You repeat this for 10 years. At the end of the 10 years, your investment of 40 lakh in equity mutual funds doubles up and turns into 1.12 crore rupees, considering the annualized return of 15%. Likewise, your 12 lakh rupees in PFs will turn into 18 lakh rupees, considering 8% annualized returns. So, when you begin your investment, your asset allocation was 80-20, but after 10 years, your portfolio had grown to 1.3 crore rupees, and in the process, your asset allocation has changed to 86% in equity and 14% in debt. In the coming years, if the equity continues to perform well, then your equity allocation can hit 90% mark as well. This is risky for any investor as their portfolio is dominated by a single asset class, which is equity mutual funds. If the stock market crashes and halves, their portfolio will also be halved, which is extremely dangerous. In order to avoid this, it is best for the investor to rebalance the portfolio regularly. We can either do a time based rebalancing like every year or every alternate year, or we can do percentage based rebalancing like if the portfolio deviates by a certain percentage, say 5% from the planned asset allocation, we can rebalance it. So what should be done during the rebalancing? It is simple. For the above example, we just have to sell some equity mutual funds and invest that amount in the debt component. As simple as that. So, how much equity mutual fund I should sell? So, in this case, we should sell equity mutual fund for the amount which would reduce the asset allocation of equities and bring it back to 80%. So, for our case, we need to sell 8 lakh rupees worth of equity mutual funds and reinvest that amount in the debt. This will reduce the equity holdings to 1.04 crores and increase the debt holding to 26 lakhs, and this will bring the asset allocation back to 80-20. And there are few things that you should remember when it comes to asset allocation. Whatever I mention here is just an example. We should not wait till 10 years to do this. This should be done periodically or regularly, say at least every couple of years. Also, while doing rebalancing, keep the tax aspect in mind and sell the units which gives us maximum tax benefits. Our asset allocation will go for a toss when market crashes as well, and in that case we need to sell some of our debt holdings and invest that into equity. This is the other half of rebalancing, and we need to do this at each asset class like debt, equity, gold and real estate, and also at each sub asset class level we discussed in the earlier episodes, like large cap mutual funds, mid cap mutual funds, multi cap mutual funds, flexi cap mutual funds. So this needs to be done at sub asset class level as well. Also, there is one another thing that you need to remember about asset allocation. Asset allocation will help you to buy low and sell high easily. I have explained in the initial asset allocation video on how asset allocation will help us to buy on the dips and during the market crashes, and how it will help us to sell our holdings on market peaks. So keep that in mind as well. If you haven't looked at that video, please do check it out. It'll be a really interesting one. I'll leave the link to that video in the description section of this video. So these are the things that you need to remember about portfolio rebalancing. And with that, we have come to end of today's episode. If you have any queries, comments or feedback about this episode, leave it down in the comment section. We'll be happy to answer it. Also hit the like button if you like this video, and share it with your friends if you find it useful. Your feedback and support is really important for us. So if you find this video useful, please leave a feedback and also share it with your friends. This will motivate us to do more and better things for you. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.